When the CEO of a company sells 90% of their own stock, they're sending you a message. Most people just aren't listening. Corporate insider selling, the legal sale of company shares by executives, directors, and major shareholders, has hit levels not seen in 20 years. According to SEC filings tracked by multiple financial research firms, the ratio of insiders selling to insider buying has reached 10 to 1. For every dollar insiders are putting into their own companies, they are taking $10 out. This matters because insiders know things the market doesn't know yet. They don't have to guess about earnings. They know. They don't have to speculate about the next quarter. They've seen the numbers. When they sell, they are voting with their own money against their company's near-term future. Let's look at what the data actually says. In the 12 months ending mid-2025, corporate insiders at S&P 500 companies sold over $95 billion in their own company stock. That is the highest level recorded since 2004, the year before the housing bubble inflated and the year before the market peaked before the 2008 crash. The sectors leading the selling are significant. Technology executives, the people running the AI boom companies, have been the most aggressive sellers. Executives at semiconductor companies, enterprise software companies, and cloud infrastructure firms have cashed out billions while publicly promoting their company's futures. Jeff Bezos sold $8.5 billion of Amazon stock in February 2024. Mark Zuckerberg sold over $185 million of Meta stock in the first months of 2025. Jamie Dimon sold JP Morgan shares for the first time in over 18 years. These are not portfolio diversification decisions. These are coordinated, systematic exits from positions that executives built over decades. Here's what makes the current selling pattern different from normal insider activity. Normal insider selling happens for personal liquidity reasons, taxes, divorce, buying a house, diversifying out of a concentrated position. It's scattered and irregular. What we're seeing now is clustered. Multiple executives at the same companies. Multiple companies in the same sectors. All in the same window. The SEC requires insiders to file a Form 4 within 2 business days of any transaction. These filings are public. You can read them for free. And right now, if you look at the aggregate data across major indices, the pattern is unmistakable. There is also the 10b5-1 plan loophole to understand. Most large insider sales are made through pre-planned trading schedules called 10b5-1 plans, set up months in advance so executives can claim they didn't trade on material non-public information. In theory, this removes the advantage. In practice, studies show that executives regularly update these plans before executing them, and the timing of sales under these plans consistently outperforms the market. The loophole is so widely exploited that the SEC tightened the rules in 2023, but enforcement remains limited. History provides context. In 2000, insider selling hit record levels as executives cashed out before the dot-com crash. In 2007, insider selling spiked across financial companies before the housing collapse. In both cases, the public didn't get the signal until the decline was already underway. Insider data is not a precise timing instrument. Insiders can be early. Markets can stay irrational longer than the data suggests they should. But over long periods, insider behavior has been one of the most reliable leading indicators available to regular investors because it reflects actual belief with real money at stake. So what do you actually do with this information? Move 1. Check the insider filing data on your own holdings. You can do this for free at sec.gov or sites like OpenInsider and GuruFocus. Look at the ratio of buying to selling for companies you own. If executives are selling heavily and no one is buying, that is information. Move 2. Review your concentration. If you hold a significant position in a single stock, especially in technology, and insiders are selling, this is a moment to review whether your allocation still makes sense. Concentration is risk. Insider selling increases that risk. Move 3. Don't confuse insider selling with a market crash guarantee. It is a signal, not a certainty. The right response is not panic, it's awareness. Adjust your risk exposure to the level you can actually live with in a 30 or 40% drawdown, because that's what insider behavior at this scale has historically preceded. The people with the most information about American corporations are telling you something with their actions. They're not saying it in press releases or earnings calls. They're saying it by selling. Subscribe to Finance Alert Global for weekly alerts on the signals that move markets before most investors know they exist.